Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome to Something More. I'm Chris Boyd here with Jeff Perry. We are of the AMR team of Wealth Enhancement. And Jeff, you thought it seemed like summer a long time ago.
I did.
Here it is, summertime.
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 Yep.
I always used to have that song on when you came on when you were in office because it has the line, "I'd like to help you, son, but you're too young to vote." But anyway, Summertime Blues is that song. But anyway.
Well, it's summertime. It's been summertime in Florida for, I don't know, all year. But
yeah,
it's summertime on Cape Cod.
It's
and
special, best time of the year. We wait all year for this.
Yeah.
Enjoy.
I know. It's so short. And you folks in the Northeast, you get a cherish.
My boat's in.
That's good. That's good.
Water, yep. A little pontoon boat. It's fun to do.
Yep.
So in any case,
get out there
everyone's
and
enjoying the season.
Right.
Yep. Let's hope we have more sunny weekends than rainy weekends, which we have been on a tear for a while. So let's hope we're start going the other way for a while.
Yep. Spend some time outside.
Yeah. All right.
Save those inside chores for next winter.
There you go. Well, our plan today was to talk about some mailbag questions.
That's right. That's right.
Always fun to. This is the old Rush Limbaugh thing. Oh, let me pull that mail out of the mailbag. Wrinkling a piece of paper.
Our mail's in the computer though, so I don't have an appropriate
email
sound effect.
We've got mail.
Yeah, not even that anymore, right?
Yeah.
So for the listeners who are just tuning in and trying to figure out who these people are and what we're talking about, these are questions or comments or issues or situations that clients, listeners to the show, talk to us about. We ask them, can we talk about this issue on the air? We don't use anybody's names, obviously, because these are
things that other people might benefit from. Yeah.
Right. These are things that, are unique. We talk to clients all day, and every question, it seems unique, but the ones that are broadly of interest to people and often are people have the wrong impression or the wrong answer. We try to bring them up in the context of Ask Chris Boyd in the mailbag.
Yeah. So these are fun to get a chance to talk about, and you may find that there's some good questions you have as well.
Sure.
And we'd welcome you to reach out to us anytime you'd like to share a question or a comment. And if you want to do it by email, easiest way would be to send us an email at amr-info at wealthenhancement.com. AMR-info at wealthenhancement.com.
Yeah, please do. Our best questions come from you for sure.
Absolutely. And you could also, if it's easier, you could, maybe call either with, you talk to a live person during business hours, or you can leave a voicemail with your question. Just let us know it's for something for the show, the podcast, a question. You can give us a call at 866-771-8901. All right.
Absolutely.
So let's dive in.
You ready?
Some good questions.
Okay. So the first question is about an IRA. This gentleman says, I have multiple IRAs, which is not uncommon, maybe not our best practice, but many people come to us have a lot of IRAs from here and there and everywhere. So I have multiple IRAs, and he doesn't give his age, but assuming he is of the age that he has to take an RMD, his question is, how many RMDs do I need to take?
It's a great question. Let's backtrack for a second. One being, if you have had in the past mutual funds,
Mhm.
it historically it used to be that you'd have a statement from your mutual fund company.
Sure.
I'd have each fund at, say, Fidelity, Putnam, MFS, Vanguard, whatever it was, right? You'd get a distinct statement. Sometimes that would be nice. All of my MFS funds would come in one statement.
In the mail, even.
Yeah.
The
But
actual mail.
but you'd get separate IRAs or separate funds
Mhm.
from each mutual fund family. Nowadays, most people use brokerage accounts.
Right.
And so if you have multiple IRAs, you might have CDs at the bank. That could be one reason to have multiple IRAs.
True.
You might have multiple brokerage accounts, but then the question becomes, why?
Right.
Is that desirable? Now, there might be instances where it is. I have this one managed with this objective, and it's separated from another objective managed with this intention. And there can be like separate managed
Yeah.
accounts.
Some people use the bucket theory for their IRAs.
Yeah, that idea of separating it out like
Right.
that. But and maybe who the beneficiary is, like I think is one of the reasons sometimes people separate it for that reason. They might have intended heirs of different reasons, but generally, I would say in most instances, it's probably a good idea to think about consolidating. Now, I don't want to say in all instances by any means.
Right.
And there can be some unique circumstances with a spousal
Right.
beneficiary who inherits an IRA, whether they want to roll it into theirs or not. There's all kinds of different circumstances. So, but do you want to comment more before I go back to
No, there's situations that you want to keep them separate for tax reasons. So, yeah.
Yeah, that's a good point. If you have some that have after tax contributions, but
Right.
in reality, the IRS looks at them all as one anyway.
Right.
Even if you don't, it's not like you can say, I'm going to roll that IRA over because that's the one with after tax contributions. I'm going to convert it as an example.
Mm-hmm.
The IRS looks at it and says, no, it's all one IRA. So you can't parse out which contributions are after tax as an example. They use the example of milk and coffee.
Okay.
Once you put it in, you can't really take it out. I'm just going to take out the milk.
Right.
Doesn't work that way, right? So think of that as an image. When you have after tax contributions, you can't separate them as easily. There are some techniques, but it's generally not possible. One other variable I want to give a caveat when we talk about this is 401ks or 403bs as distinct from IRAs.
Mm-hmm.
Your work plan has its own distribution requirement from your IRA. So if you have a 401k and you have 5 IRAs, your IRAs collectively, they all have their distribution requirements. I'll come back and talk about that in a second. But you can't lump your 401k distribution requirement into the amount you're taking out of your IRA or IRAs. Okay. You have to take your 401k distribution or 403b distribution from that plan. And you have to take your IRA from IRAs. Now, what if I have 5 IRAs? It's all my IRA. We just said the IRS looks at it all as one.
Yep.
I have the option to say, I'm going to take it all from this one of the 5 accounts, or I'm going to take the proportionate amount from each account. It's up to you how you deal with it, because what's going to happen is the custodian's going to send a notification to the IRS to say, oh, this is the amount that was required to be taken out, and they will disclose whether it was taken out or not. But if you took more out from one and less out from another, as long as it all works out in the wash, you're okay. Okay. So, but with the distinction that that's not true for the work plan type distribution requirement. It might be calculated, very same calculation method, but it's separate money.
While it's still in that workplace setting. If you had rolled it over,
Now it's part of your IRA.
One IRA again.
Yeah.
Right.
Yeah, exactly. So I don't know. Anything to add to that?
No, I think you covered it very well. It's one.
Yeah. So you can do it however you want. One, a little bit from all. If it's IRA, it's IRA. It doesn't matter which account you take it from.
Very good. Shifting gears away from IRAs to
Okay.
we talk about when people talk about or they see them in publications or TVs, all these rules of thumb, right? For
Yep.
in everything in life, but especially financial planning. Rule of 72, how
I know
long it
that one.
takes to double your money. So this one is the rule, or the question is, what is the rule of 25?
You might have to answer this. I wasn't thinking of this when you said it. I think of the 4% rule.
You and I have
saying,
interesting math.
yeah, yeah.
We do.
And I think, oh well, how much do I need if I want X dollars and I'm going to take 4%? I might back into a lump sum of money. This is the same equation, just a different way to do it.
It is. So let's set the stage a little bit. So this question is considering I have my nest egg, and how big does my nest egg have to be, and how much can I take safely per year, if you will, that my nest egg lasts for my lifespan, right?
Mm-hmm.
So the rule of 4% that you're suggesting this is related to, and I'm going to agree with you, is from an old study. Do you remember the decade? Was it the 70s or the 80s?
I think it was the 80s, but
80s, where they did this, 1,000. I don't know if it was a Monte Carlo based scenario, but they did that. If you have a 50-50 portfolio, 50% stock, 50% bond in your nest egg, your retirement nest egg, and you take 4% annually and then adjust it upward, presumably for inflation, that your money has an excellent chance. I don't know if they put a number on it, but
you have a high probability you won't run out of money.
Yeah, in 30 years, right?
Well, again, the demographics were different at the time. 65 was the retirement age that
right.
typically people.
That's right. That's another factor that was in that, right?
And it was, the notion of how long people would live was maybe not as long as we might assume today.
Right.
So there's been subsequent debate about should the 4% rule be lower, 3% or something like that.
Sure.
But and as you said, that it assumed that you were going to continue to increase it over time.
Right.
It takes no account of market fluctuations the way maybe behaviorally we might want to. It also assumed that, if you started at 75, you'd have a different percentage calculation. So there were different assumptions through this study of, how much could you withdraw, what rate of withdrawal could you do without the risk of running out. It might not assume you'd have money left over,
right?
But you were trying to do it so you would have a low probability of running out of money.
Exactly. So and the rule of 4% is just thrown around as like common knowledge.
Yeah.
So the rule of 25 is how much do I need in my nest egg to generate sufficient income under the same scenarios, right? So if you make $100,000 a year and
you want to spend $100,000 a year in this
that's
case.
Right. If that's your base cash flow, it means you need, so the rule of 25 is 100,000 times 25 or 2.5 million. That would be what you need as a single amount invested to be able to generate $100,000 a year.
Interestingly, 1/25th is 4%. It's the same thing. It's just different ways of going about the same calculation. I just didn't know what you meant when you said the 25 times rule. I hadn't heard it in that expression.
Well, I had heard about it. Nowhere near the 4%, but the way I think about it, and I'm not saying it's not a golden rule to say I'm throwing everything else and this is all I need to do. But while you're working, you need to save, and your goal should be 25 times what you believe that you're going to be withdrawing. And then, just using these rules of thumbs, not endorsing them, but for the sake of answering this question, then if you take that 4% in retirement, kind of your accumulation phase and your distribution phase, it's the same math. Just
Yeah,
look at it from
yeah.
different sides of
And
retirement.
it's a rule of thumb. It's not by any means intended to be a sophisticated methodology of
Not at
calculating
all.
what you
No.
need. But as we've said many times,
Mm,
it's best to do a comprehensive financial plan where we take into account a number of variables, realistic thoughts about what you want to spend for goals, for realistic cash flow. We can depict a mortgage expiring because it's paid off, whatever.
sure,
You
sure.
can really get granular and see how does this forecast, and in the way we do it, it does it using a Monte Carlo simulation. It looks at an assumed, based on the way you're invested, or the way you might forecast being invested.
Right.
What kind of rate of return might we expect? What's the standard deviation associated with that? So we can get a sense of the range of probable outcomes.
Mhm.
And we want to make sure that the preponderance of those are ones where you're not going to run out of money.
Yep.
Hopefully there's abundance, right? Left over, right? And plan for the next generation. But most people, it's funny, that's something we should talk about as a separate episode sometime, is the idea that people sometimes want money left over and sometimes people want nothing left over.
That topic's on our list, so it's already there.
Yeah, let's
Yep.
do that.
All
Okay.
right. And all of our lives are different. All of our goals are different. All of our needs are different. Our wants, our what ifs. So rules of thumb are entertaining to talk about, and maybe to have in the background as broad goals that you might have for, in this case, accumulating assets. But when it really comes down to making that decision, or when you're getting close to making that decision, you really have to drill down on your individual situation and put together that plan and have some confidence in that plan, and have a plan that you can follow, not only to make the determination of can I retire, but in retirement that you can monitor it and just have that sense of this is going to work or this isn't going to work.
Yeah. I totally agree. It's you can you can pay attention to the rules of thumb to help keep you on track,
Right.
but do your own deliberate
Yep.
process. Don't just rely on a rule of thumb.
Please.
Get you started.
Yep. So this question, I think, is going to go two different ways, but I'm going to frame it. Not the writer, the submitter of this question didn't frame it, but I know what they're talking about. Have you heard I don't know, over the last few years, just these random commercials about title theft?
Not really. I mean, I guess I've heard of title theft.
This is home property title theft, where a bad actor will, the title records are public, right? So
yeah, they'll try to steal your identity, essentially.
so they would go in, and if I'm trying to steal your title, I would get some personal information about you, which isn't hard to get, and I would look up your deed, which isn't hard to do, and I would write a deed fraudulently and convey it to myself, I guess, in this example,
Yeah.
maybe a third party, and then I would go take a mortgage on it and get the proceeds from the mortgage, and then I would disappear. And then you, not knowing any better, because you're not checking your title,
Yeah.
5, 10 years, 30 years from now, maybe when you pass, somebody sees it and say, "Hey, well, there's a overdue
or I have to worry about getting foreclosed on my
Oh, yeah, right. Or get
property.
the bank statements, right?
Yeah.
So there had been a number of, and I don't mean a large number. I mean, in the scope of frauds. We just did a show on fraud.
Yeah.
But on the scope of fraud, this is a very minor issue, because if you think about what it takes, first of all, you need a bad actor, which there's plenty of those around, but you you need someone who is going to have your identity, meaning you're an actual license or government issued, because somebody has to sign this in front of a notary. So that notary has to be corrupted or corruptible, and they have to use another fake ID because they're probably not another fake identity because they're probably not going to put it in their own name and get caught eventually.
Yeah.
And then it has to be actually recorded. So there's been a few stories about this, which spurred a industry selling insurance, which basically says, we'll lock down your title, which isn't technically true because they don't lock down your title. What they do is they notify you if any activity goes on your title.
Okay.
And then you get a notice. But at that point, it's already happened. And so you still have to go and probably get a lawyer and go into court and say this is fraudulent. But there's lots of these title lock insurance companies out there that are scaring people and selling these insurance policies, in my opinion, that are really not necessary. Many counties, including the county that I live in, you can, I don't know about the county that you live in, Chris, but many counties now have these services where you can go and sign up on their website, the actual county government website, and sign up to be notified if there's any activity on your property. So basically they're doing it for free.
For free. Yeah.
So this is not to be confused with title insurance.
Yeah, when I hear title insurance, I think of what, someone, if you said, should I have title insurance? I'd be, oh, yeah.
Yes, you should.
It's a question of where research when you're buying your home, whether there's clear title to your home.
Right.
And you don't want someone else having a claim to the equity, the home you've purchased with all the exposure you have with a mortgage and all that. After you paid off your mortgage, somebody coming along saying, well, that's actually mine now.
Right. And it defends you against someone making claim. Like 30 years ago, there was a transaction and some relative has come forward or some bank has come forward, and the insurance is there to protect you from that. And that is...
Sorry, that's not yours.
Right.
Sorry.
And
use a
title insurance, like when you buy a home, they'll defend that claim. And if you lose, they will actually pay you for your financial loss.
Yeah.
So many states require title insurance.
Yeah. I mean, I think it's appropriate. But so there's a different. What's this one called? The one with the
title lock insurance. Lock insurance. I'm not surprised at all that they use a similar name.
Yeah.
Because people buy a house every however many years, and they know that title insurance is something that their lawyer told them to get, and now they hear an ad about it. And with every ad, there's this, these people creeping around outside your house, signing deeds. It's unfortunate. I'm not going to call it a scam because they do provide a service.
Yeah.
But in many cases, it's a service that is already provided by your county.
And may not be
or it's one if you want to log on to the Registry of Deeds and check your title every week or month, you can do that.
That's true.
And if something happens, these companies are not doing anything for you. They're just telling you that a crime has happened. And then you still have to hire the lawyers, still have to clean up the title and so forth. So in my opinion, title lock insurance is not something that we need to buy.
All right. We won't.
I haven't. All right. We have one more question for today in the mailbag. Going back to RMDs.
Okay.
IRAs, RMDs on IRAs, required minimum distributions. Do RMDs affect my Social Security?
That's an interesting question. Do RMDs affect my Social Security? I think of the tax part of the question first.
Oh, we process differently, for sure.
Yeah, my first thought was, well, yeah, you might have less Social Security benefit due to how your Social Security benefits are taxed.
Right.
Depending on your income level, your Social Security is taxed at different rates. Well, different percentages are subject to tax. Let me put it that way.
Right.
So you could have 0% of your Social Security subject to tax. You could have half or 85%. And then
doesn't mean you're losing that. You just taxed on it.
No, it just means it's subject to tax, and then the rate of your taxes depends on what's your tax rate? But it depends on how much income you have that
Right.
defines the answer to whether or not you're subject to tax, and to what extent. So in that sense, IRAs have an impact on your Social Security, but I don't think that's what they're really intending to. Is you were thinking more about, does it affect your benefit amount?
Yeah. So
Calculation? Is that what
that's
you're
how
saying?
I think you could honestly read it either way. But just for clarification for the listeners,
Yeah.
your RMD or your IRA withdrawal, even if it isn't an RMD,
Yeah.
does not affect your benefit that comes into your checking account. If you're getting $3,000 a month, no matter what your RMD is, you're getting $3,000 a month. Period.
Right. Now, we talked about Irma earlier
Yes.
in a different
I think
episode,
it was
was it?
last week.
Maybe
Yeah.
it's a different episode.
Yeah, last week.
But your calculation of benefit of the cost of the cost of your Medicare premiums
Right.
is impacted by your income from 2 years prior, essentially. So your Social Security benefits will be affected in a sense, not gross, but net, how much you get to keep after your Medicare premiums can be affected by how much you take out of your IRA.
Right. Not just at age 63 is what we were talking about last week, but any year.
Yeah.
It can bump up your premiums if you have a significant change. And once again, I think we said it last time, if it's a one-time thing for some reason, you can appeal, and it will readjust later. But to the questioner's question, it doesn't affect your dollar amount that you receive, but the net.
Yeah. Is affected. So you're not, when you take a withdrawal from your Social Security, you don't pay FICA tax. It does not benefit your or self-employment tax. That money that's coming out of your IRA is not contributing on your behalf to the Social Security system as wages.
Right.
So it doesn't, it's a non-factor for whether you'll get an enhancement, let's say, in your Social Security calculation. But it does have these other potential implications for how much you might receive to spend when it comes to your Social Security because of either tax consequence or Medicare premium impact.
Right. Exactly.
All right. That was kind of a nuanced answer I think we hit on there.
Well, I think when people have these confusion about this issue, which is not complicated, but because people think benefits versus, does my benefit change? Well, no, it's the short answer, but yes is the longer answer.
Yeah.
Right? Because it actually, at the end of the day, you're going to put a little bit less in your pocket than you thought because Uncle Sam's going to take a bite of it.
Right. Yeah. Good question, though.
Good question. I can see why people aren't clear on it.
Once again, if you would like to reach out to us, we'd love to hear from you. You can do that by connecting with us at amr-info at wealthenhancement.com. And we'd love to have you send in your questions. And with that, thank you for being with us. Hope to hear from you with some new ones. And until next time, if we can be of help on your efforts as you deal with any of your personal challenges, questions you might deal with, we're happy to speak with you in a consultation, a complimentary consultation, see if we can be a resource. In any case, until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll-free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.